Today we are going to discuss Chapter 8, Receivables. Receivables are asset, and they came into being when a business sells a goods or service. So either you are providing a service or a product. So the customer is the customer is gonna give you cash, or it's gonna give you a promise. That promise is going to give you a receivable. That receivable could be short term or could be long term. If it is short term, we call it account receivable. If it is long term, we call it note receivable. That's the idea behind a receivable. It's a monetary claim, means you're going to receive dollars against a business or an individual. You will receive dollars. A receivable is a right. So it's a right to receive cash from with whatever transactions that they have. A creditor is the party who receives the receivable. So basically a business, in this case, the one who is selling either a service or a product, is a creditor, and the person who is giving you a promise is a debtor. Means the debtor at some point later in future, they will have to pay the creditor. A debtor is a party to creditor who is obligated. So you have a right to receive and they have an obligation to pay. Account receivable are also called trade receivables, represent the right to receive cash in the future from customers for goods or services, just exactly like an account receivable. Account receivables are generally collected within 30 days. It could be 60 days, but majority of the transaction assume that the person who is buying from you on a promise that he or she will pay you later, the idea is 30 days. It's always reported as a current asset. So this account receivable that we talked about, it's a current asset, and a note receivable sometimes is a current asset if it has a life of less than 1 year, and most of the time it is a long-term receivable and life is longer than 1 year. Note usually have longer terms than account receivable, are sometimes called promissory notes. It has to pay a fixed amount of principal plus interest. So account receivable, the debtor or the person who's giving you the promise don't have to pay any interest on it. But when it's a note receivable, you'll have to pay a interest on it by the due date. And the maturity date is the date on which a note receivable is due with principal and interest. Other receivables that we have talked about could be dividend receivable, interest receivable, and taxes receivable. Okay. Internal control over receivables received by mail, mainly checks or online EFTs, but majority of the payments is in these days and times is EFT or electronic fund transfer. Means customer will send you the cash directly from his business account to your business account. Is a separation of cash handling and cash accounting duties that we talked about in chapter number 7, that if somebody is receiving a check in the mail, that person should not deposit the check but just make a list of all the checks. Another person will go and take the checks and take the payments against the invoices that has already been issued, and a third person will make the third person will make the deposit slip, and the third person will go and deposit those checks in the bank. So there are 3 different people involving in it, which we call separation of duties. We discuss in details in chapter number 7. Credit department, the one that authorizes customers to receive credit, should not have access to cash. That's another thing. Those who handle cash should not be able to grant credit to customers. Otherwise, there is a appearance of or collusion. Decreasing collection time and credit risk. Companies must wait to receive cash from sales on account. On account simply means every time, I think we discussed in chapter number 1 as well, on account simply means selling on credit and will receive the cash at a later date. Some accounts are never collected. So that's another reason, the danger of selling things on credited. Sometimes you are unable to collect the cash. Options to decrease collection time while transferring the risk of non-collection to a third party include credit card and debit card sales. Means if a customer does not have a cash, they can pay you either using a credit card or debit card. The factoring is available for those businesses that they are sitting on a account receivable and they haven't received any cash from the customers. They can sell these account receivables to a bank or any other institution. So for example, if you have $100,000 worth of account receivable and you want to sell it, the bank may pay you $75,000 or 75 cents on a dollar for to buy all these account receivable from you. So what do we call this uncollectible amounts that you are unable to receive? It's the bad debt expense. So we have a bad debt expense simply means the expense or the cash that you have not been able to collect it from the customer. So it arises failure to collect from some customer who purchased on account or credit but did not pay you. There are two methods that we're going to talk about for uncollectible receivable. One is called direct off method. It is, we do it in tax accounting and cash accounting. When we are using either a tax basis of accounting or cash basis of accounting, we use a direct write-off method. When we are using accrual basis of accounting, we use allowance method, and that is the method is required by GAAP that all the companies, all the businesses that using accrual basis of accounting should use the allowance method. So let's talk about what is a direct write-off method. For uncollectible, in which company records bad debt expense when a customer's account receivable is uncollectible. So for example, after 6 months, you find out that the credit that you have given to so and so businesses, they are unable to pay. Maybe they shut down the business or they have filed for bankruptcy. You just debit the bad debt expense and you credit the account receivable. So you kill the account receivable, but your bad debt expense is going. So that's the method for direct write-off method. Okay. Primarily used by small non-public companies. Account receivable written off, just like I credit the account receivable when the business determines that it will not be able to receive from the customer. Once the account is written off, the company stop pursuing the collection. Basically, you have a loss, and that's about it. What is a limitation of direct write-off method? It violates the matching principle. What did we discuss in a matching principle? Once you have a claim on a customer, what you do, you say credit sales revenue. So what accrual accounting says, or the matching principle say, once you have recorded the sales revenue, you cannot reverse it. What you need to do, you can kill the account receivable if you did not receive the cash, but you cannot kill the sales revenue. Therefore, we cannot do this. So in this case, you saw we did debit bad debt expense and credit account receivable. That's a good way of doing it. but we cannot kill the sales revenue. We have to record the sales revenue. So a company record the sales in 2017 and related bad debt expense in 2018. This result in overstated net income in 2017 and understated income in 2018 and overstated account receivable in 2017. So these are the three things happens if you use the bad debt expense. The write-off method is only acceptable for companies that have very few uncollectible receivables. Now we're going to talk about the allowance method, the method that GAAP or US GAAP wants us to use. Is the allowance method is based on the matching principle, and it records bad debt in the same period as the sales revenue. So what we do, we create a contra asset account called allowance for bad debts. So allowance for bad debt, what we do basically, we created an imaginary contra asset, means an account that is contra means opposite, and asset. So account receivable is an asset account. So we are creating a opposing account called allowance for bad debts to reduce the account receivable to a net realizable value. So GAAP requires an estimate to be made of bad debt expense at the time of revenue recognition, even though the actual account to be written off are unknown at this time. This is an example of matching principle. So for example, at the beginning of the year, your manager told you that we expect that we're going to have a sales of $1 million. So throughout the 2023, we are going to sell $1 million of worth of our product. But your manager also said that it's very much possible that all these sales going to be credit sales. Means we are not going to receive the cash right away, but we have to wait at least 15 to 30 days to collect the cash from the customers. And based on this business prior experience, it is possible that 3% of these credit sales will not be recovered. So for every 100,000 you will not receive of sales, you will not receive $3,000. So for $1 million, you may not be able to receive $30,000. That number, 30,000 number, is just an estimate. So it could be more than $30,000 or it could be less than $30,000. So they create a account called bad debt expense. So what they do, they say debit bad debt expense for $30,000 and credit allowance for doubtful accounts or bad debt expense, whatever you want to allowance for doubtful accounts, for $30,000. This information goes to the income statement for the same year, and this information goes to the balance sheet. So what do we have? So we have an allowance for doubtful accounts. So that's a balance sheet account. So it goes right below the account receivable allowance for doubtful accounts. So for example, you have a $100,000, $1 million account receivable, and you have $30,000 estimated loss. So your net realizable value for account receivable is $970,000. So you are telling the people that this year, during 2023, I would have a sales of $1 million, but I may not be able to collect $30,000. So my account receivable value 907, and of course this number will be changed throughout the year. And then this estimate, you do it one time and you ran out of the entire $30,000 by say September, and then you need more, so you're going to estimate again for it to increase it. Okay. The process is executed using the allowance method. The estimate results in an adjusting entry to the contra asset account and records losses from failure to collect receipt based on company's past collection experiences. So 2%, 3%, 4%, 5%. That's how you do that. So record uncollectible account expense, set up contra asset account, allowance for uncollectible accounts or doubtful accounts, and shows the amount. So for example, for this one, I already did over here when I say debit bad debt expense $30,000 and credit allowance for doubtful account or allowance for uncollectible accounts, $30,000. That's set up this account. Example, here in the balance sheet, you have account receivable $10,000 and you have allowance $900 that you may not be able to collect. So your net realizable value or net account receivable is $9,100. And the uncollectible account will go under expenses under income statement for $900. Now, how we do the writing of uncollectible accounts? An allowance is established for the estimated accounts, which we have already done in the past. Instead of recording a bad debt expense, the company records a debit to allowance for bad debt. So how we do that? So for example, you have allowance for doubtful accounts, you have a balance of $30,000, the one we set it up last time. All right, so this is allowance for doubtful accounts looks like. And now you also have an account receivable, say $2,000, and you want to write off that account receivable. So here is your account receivable balance. Say you have an account balance of say $25,000. I'm just making up these numbers. And now you know that the $2,000 account receivable needs to be written off. So what you're going to do, you're going to say debit allowance for doubtful accounts for $2,000, and you're going to credit account receivable for $2,000. So you put $2,000 over here, you put $2,000 over here. So now your account receivable is $23,000 and your allowance for doubtful account is $28,000. So that's how you do this. So to write off account receivable. So the entry to write off this point, to write off account, entry to account, entry to write off an account. So eliminating and recording bad debt expense using allowance method. Companies estimate bad debt expense based upon experience, industry in which they operate, and other variables. There are three methods to do this. One is called percentage of sales method. There is a percentage of receivable method and aging of receivable. These two are mostly used, percentage of sales method and aging of receivable. However, some companies also do percentage of receivables at the beginning of the year and also use aging of receivable at the end of year. Okay, so let's move to percentage of sales method. Percentage of sales method computes bad debt as a percentage of net credit sales. You have to estimate at the beginning of the year how much sales you're going to have, and then you take the percentage. Some companies use all sales, not just credit sales, and this method is called income statement approach. So the entire method, the percentage of sales method, is called income statement approach. Aging of receivable is like percentage of receivable method. In the aging method, business group individual account based on how long the receivable has been outstanding. So for example, 30 days, 60 days, 90 days, 120 days, 150 days, 180 days, 360 days. So if it is 30 days, chances are very high that you will be able to receive. But if it is 360 days, chances are very slim that you would be able to receive it. Okay. So here is an example that we have done for aging of receivable method, in which, okay, so this part of the information will always be provided to you in an exam, quiz, or homework. All you have to calculate is this column allowance required. So for example, in this, they say that 0 to 30 days past due are 8,000. Current here is simply means probably you did it today. And there is a 3% chance that you will not be collect 3% of this 10,000. Here is 4% chance that you may not collect 4% of the 8,000. 31 to 60 days, there is a balance of 5,000. There is a 5% chance. For 61 to 90 days is a 10% chance, and over 90 days there is a 30%. So when you multiply 3% of 10,000 is 300, 4% of 8,000 is 320, 5% of 5,000 is 250. 0.10, 10% of 3,000 is 300, and 30% of 4,000 is 1,200. So if you total these things, you will find the total amount is 10 plus 8, 18, 23, 26, 30,000. So the whole amount is 30,000, out of which you will not be able to collect 2,370. Okay. Assume this company has a beginning credit balance in the allowance for doubtful account is 4,000. So let me show you. So this is allowance for doubtful accounts. There is a debit balance and there is a credit. So they have a credit balance of $400. All right. And the required entry to be as follows. So to record the bad debt expense for the period, bad debt expense is 1,907 because you have already, so you have to create a balance of 2,370. So what is the difference between 400 and 2,370 is 1,970. So you will record debit bad debt expense. This is debit bad debt expense of 1,903 at 70 and credit allowance for doubtful accounts for 1,970. If you have 500, so that number will be 1,800. If it is 100, that number will be 2,270. Just to let you know. The company will write off a receivable when it determines the amount will not be collected. Okay. The write-off will not affect either expense or total asset. Rather than entire entry simply cleans up the account receivable. Assume $200 of outstanding receivables determined to be uncollectible. So what we're going to do again, like I show you, you're going to debit allowance for doubtful accounts for $200 and you're going to credit account receivable for $200. That's all you have to do. The important part is recovery. If somebody, this person comes back to you and say, hey, I am very sorry, I didn't forgot to pay or was out of time, didn't pay. All you have to do after this entry to recover, you're going to say debit account receivable for 200. You're going to credit ADA or allowance for doubtful account for 200. So only thing you have to do is just switch this entry or reverse this entry by debiting what you have credited and credit what you already, and this is the first step, and the second step will be debit cash for $200 and you're going to credit account receivable for 200. This is only for recovery. This is to write off, this is to recover. Now here is another example for recovering. Assume $400 that was written off is later collected. To write off uncollectible, you do debit allowance for doubtful account and credit accounts receivable. To reinstate, that's the first step. If you are collecting, debit account receivable and credit allowance for doubtful account. And then to record the receipt of cash, you just say debit cash and credit account receivable. In the percentage of sales method, estimate the as a percentage of credit sales for a given period. Percentage use is usually based on historical past credit losses. Assumes Apple's accounts have the following balances. So suppose they have account with receivable. This company Apple is 17,546 and the allowance left over is $10. Example, for percentage of sales, assume Script company has 2013 credit sales of 700,000 and past experience that 3% of the sale will not be ultimately collected. So bad debt expense is calculated $700,000 multiplied by 3% is 21,000. To record the bad debt expense, we're going to say debit bad debt expense $21,000 and credit allowance for doubtful accounts or uncollectible is $21,000. So doubtful is equal to uncollectible in case if you have difficulty relating these two, the same thing. They are exactly the same thing. So examples of percentage sales method, again, a credit department uncollectible is 4% of total revenue, which is 182,795. So your uncollectible amount would be this number multiplied by 0.4, which is $73 million. You're going to debit the uncollectible and credit the allowance. And that's how you're going to put it together. Okay. Losses from account receivable. Business extend credit to increase their volume of sales relative to a cash policy. The idea is if you only sell via cash, your sales will not increase. So in order to boost the sale, you should offer credit to your customer. That they will not likely collect 100% of all their sales, but they still like to offer credit to their customers. Credit losses are considered an operating expense and are debited to bad debt expense. Why are we calling operating expense? Because it's a cost of doing business. Analyzing receivables. A key measure of analyzing is determining the speed of collection. We like to collect as quickly as possible. Two ratios that will not be a part of your exam. These ratios will be a part of your exam number 4, not 1, 2, and 3, and final exam. So these, when we talking about any ratios in the lecture, they will be in exam 4 and final exam only. The exam 1, 2, and 3 will not have any ratios. All right. So one is called the account receivable turnover and the average collection period. These are the two. So what is account receivable turnover? Is net sales divided by average. So how do we calculate the average? Account receivable is the beginning balance, which is on this January 1st, plus the ending balance, which is December 31st, and divided by 2. So that's how you calculate your average account receivable. Average collection period is 365 divided by the account receivable turnover. Okay. Now that we're going to talk about factoring and discounting, a company can speed up the collection of cash, on accounts and note receivable by selling the receiver. Factoring is another word for selling. There are two methods of factoring. One is called with recourse and without recourse. You really do not need to know, but these are the two methods that we use. And we going to if the receivables are sold with recourse, the buyer has the right to return the uncollected receivable to the seller. If they are sold without recourse, the buyer may not request reimbursement for the amount ultimately not collected. Okay. A direct write-off method, we have already talked about it. Notes receivable. A note receivable is a written promise to pay a specified amount. So how note receivable come into being? So you have a sales. Sales give you two things, either account receivable or cash. If you get cash, that's perfectly fine. If you get account receivable, there are two things going to happen. Either you're going to receive cash or somebody may request you to convert this account receivable into a note receivable. In a note receivable, you're going to get the principal amount, the amount that they are financing, plus the interest. All right. At a particular date, usually with interest, usually almost together. Maker of the note, debtor, the entity that signs the note and promise to pay the required amount. So we have two parties in notes receivable. One is called creditor and the other is debtor. The creditor is the lender and debtor is the borrower. There is a principal, so amount. There is a interest rate. There is a beginning, what do you call it, date of issue, and maturity date. Maturity date is the same as due date. So you will have a name of a lender and a name of a borrower. You have a principal, say it's $10,000. Interest, say 5%. Date of issue, say September 1st, 2023, and maturity date may be August 31st, 2024. So on this date, the lender will receive $10,000 and a 5% interest, so 5% of 10,000, say $500. So that's what they are going to receive. So key characteristics: fixed due date or on demand, certain principal, which is an amount that you are borrowing, interest rate, interest calculation, and the definite sum plus interest at a maturity. That's all. And here is a definition of all those things that I was talking about. Identifying them. Some note specify the maturity date. Like I said, August 31st, 2024. Other note state the period in days or months. So they may say it's 270 days or 12 months or 365 days or 2000 days. It could be anything. When the period is given months, the note's maturity date falls on the same day of the month as the date of note was issued. When the period is given in days, the maturity date is determined by counting the actual days from the date of issue. Okay. So because you will have some questions in the homework, quiz, and exams that has month, and in some you will find days. So you need to learn both methods to calculate the interest rate. Okay. The next thing is computing interest on the note. The formula for computing the interest is follows: amount of interest is equal to principal multiplied by the interest multiplied by the time. Assume a 3 months note for $10,000 at an interest of 6%. So how we calculate the amount interest will be $10,000 principal, interest rate 6%, so we 6/100, and 3 years out of 12. So that's how we calculate this number, and that will give us the answer. And the interest rate, you can see that I wrote 6/100, or 6/100 is equal to 0.06, and it's $150. In this formula, time represents the portion of a year that interest is accrued on the note. It may be expressed as a fraction of a year in months or a fraction of year in days. So it could be 90 days. It could be 3/12, or it could be 90 days divided by 360. Okay. Recording dishonored note receiver means somebody, they do not pay you. When a maker dishonors a note, the dishonored note unpaid interest are transferred to account receivable. Later in the account receivable can be written off under direct write-off method or allowance method, whichever method you are using it. Other receivable, miscellaneous category for other receivable include interest receivable and advances to employee. Internal control, separation of duties and separation of cash handling, we have already talked about. Bank is the best, and log box system is the second best. In credit sales, the benefit is customer can buy on credit, so sales and profit increases. Cost, company cannot collect from some customers, record as uncollectible account. Shipping terms, we have talked about it. FOB, free on board. Shipping point, the ownership changes hands and revenue is recorded when goods leave the shipping dock. In FOB, free on board destination, the ownership changes hand and revenue is recognized at the point of delivery to the customer. Okay, here this is the lecture for chapter number 7. I have also provided you a lecture on a detailed question from this chapter. I solved the question on this video, so please make sure that you watch that video under the name of comprehensive problem with solution. That will help you understand what we are talking about in this chapter. So the videos that is provided to you by the Pearson, this video and the video that I have done for comprehensive problem will help you learn more about this topic. Again, thank you very much for watching this video, and if you have any suggestions for me to improve these videos, please do let me know. Thanks.